For me, I've spent so much time thinking about this and seeing the obsession over X and on the Real Vision platform with the cycle. I must take the money off the cycle. I must buy the bottom. And I've seen it time and time again, is even if you time taking money off, right, the probability of you putting that all back in later is pretty close to zero. In fact, you end up not sure where the bottom is, so you'll end up scaling on the way up, and you end up doing what I did, which was it up over time by being suboptimal in that process. You're really better to try, if your game is to make some long-term wealth, compound, and then by buying when it's oversold, and then you will have a lot more wealth in the end, and you can make bigger decisions with that.
For many crypto investors, the last several months have been frustrating. Despite all the bullish headlines, growing institutional adoption, and a seemingly endless stream of positive developments, the market has not always moved the way many expected. Every rally has been met with anxiety. Every pullback has sparked fears that the cycle is over. And for many investors, watching stocks continue to reach new highs while commodities remain resilient has only made the feeling worse. The reality is that many crypto holders have become exhausted trying to predict every move. Social media is filled with debates about tops, bottoms, cycle peaks, corrections, and crash predictions. Investors constantly ask themselves the same question: should I sell now and buy back lower later? The problem is that while timing the market sounds easy in theory, history shows that very few people consistently get it right. More often than not, emotions end up becoming the biggest enemy of long-term wealth creation. That is exactly why today's discussion is so important. Raoul Pal, one of the most respected macro investors in the world, believes most investors are focusing on the wrong game entirely. Instead of obsessing over every market cycle, he argues there is a far more effective strategy that can potentially build significant wealth over time even during periods when the market feels disappointing or far below expectations. More importantly, he explains why some of the biggest opportunities in crypto may still lie ahead. Before we dive in, if you enjoy thoughtful analysis on Bitcoin, crypto, macroeconomics, and financial markets, please take a moment to support the channel. Hit the like button, subscribe if you're new, and share this video with someone who could benefit from hearing these ideas. And most importantly, leave a comment below and tell us, do you agree with Raoul Pal's approach, or do you still believe actively trading market cycles is the better strategy? Now, let's hear what he has to say.
But again, here's the chart of the market cap of crypto. Again, the network adoption model is playing out. We're currently like a $2.5 trillion asset class today. If we follow the trend rate of adoption, which is how these things usually always play out, and considering the entire banking system is building on this, that sovereign wealth funds are buying Bitcoin, that stable coins are going exponential, that the US Treasury is funding the short end of the curve via stable coins, that the Clarity Act is going to get passed, and all of these things tell you the probability that this trend continues and we get to 100 trillion by, let's say, 2034. So that's 8 years' time. We go from 2.5 trillion to 100 trillion. That would be the largest wealth accumulation event in all of human history. It would also be gigantic returns. Because within this, there'll be some things that outperform, some things perform in line, and obviously a whole bunch of stuff, most of it won't do well. The thing is to be in the things that matter. Go back to the same point I keep raising. The long-term trend is the game. It's not really about the cycle. And I know everyone's obsessed by it because nobody likes to take the down markets, but it's really not. It's about compounding. So let's talk about making compounding easy. And so I've built something that's going to be launched on Real Vision soon, which I think just helps this. So it is the GMI compounding machine. Now I'm going to change my screen here and I'm going to show you the GMI compounding machine. It's pretty simple, but it helps a lot, I think. So what we've got with the GMI compounding machine is I've got two tabs, NASDAQ and Bitcoin. It shows you where it is today. It shows you it is versus the trend. So here is the log trend that we've been using. Now you might say Bitcoin's a power law. It doesn't matter. You can adjust for that. And I'll show you in a sec. We're 38% below where fair value is according to Metcalfe's law right now. And what I've said is we're going to buy when we're one standard deviation oversold. So these bands are one standard deviation overbought, two standard deviations overbought, the trend, and oversold. So I can change this dashboard to say, hey, I'm going to put 100 grand in. And I'm going to buy I'm going to add compound when we're oversold by one standard deviation, 1.3, whatever number we want. I'm going to choose 1 for now because that's where I like to do it. I want to buy, and we can see it bought 4 times, 5 times, including recently. Okay, I want to take some lifestyle chips off because it matters to me and I don't want the psychology. So I'm going to take lifestyle chips off maybe when we're 1.5 standard deviations overbought. Now, that's only happened twice. We didn't have it in this cycle. We had it in the past cycles. Okay, fine. So let's change it to 1.5. It's at 1.4 right now. 1.5. Now, I want to add, and I'm going to save money in the meantime. For every time it gets to 1 standard deviation, I'm going to add 25% of my initial bet, 25 grand. And I'm going to sell 20% of my entire Bitcoin stack if it gets up to there. Okay, so this is managing the cycle that some of you want to do. What it means is I will have had to invest 225 grand. So I've had to add to my initial investments. Now I've taken 260,000 off, but I often use that money. You can either put that into lifestyle or use it to buy these dips. So you're selling strength and then using the same money to buy the dip. I've now got 1.9 million in Bitcoin in the market. If I just held and not done the buys and sells, I've had 1.6 million versus the no sell strategy. I had just bought every time it's sold off. I'd have compounded to 12 times my money at 12.6 million, 2.6 million. So I can change these. So maybe I don't want to sell anything. I can do it that way. I can change it by whatever structure I want. How much more to add? I could be more aggressive and add 100 grand, double my bet every time. Well, it does 105 for some reason. Every time we get oversold, but maybe I say, you know what? I only want a few signals oversold, and I'm going to sell only when it's overbought by 2 standard deviations. Okay, now look at the difference here. So I've now had to invest 415,000 because I put some big bets in. I've sold 1.4 million, but I'm still out of pocket 240,000 overall. So that's the net cash outlay. That was after 100,000 initial. So that's cost me a lot of money, but I've got 3.7 million still left in the market. I've made some good money now. If I'd just held and done nothing, I'd have made 1.6 million. But now, had I not sold, I'd have made 7 million. So you can see the difference and you can play around what works for you. And it works exactly the same for the NASDAQ. I can do the same thing. I can see where it works. The NASDAQ's always in a beautiful log regression channel. It gives you a lot more entry levels, but maybe I only want to buy when it's 1.5 standard deviation. So you can play around with this, but this is how you think about it. Do you just buy every time it sells and just keep running that core position over time and absorbing the buys? Or do you want to sell into strength, take some money off the table, and or reinvest when the market falls? Those are up to you. They're your risk profile.
Buy $10,000 of Bitcoin on a regular exchange. It grows to $60,000. That $50,000 profit? You could owe $10,000 or more in capital gains tax. Now do the same trade inside a Roth IRA with iTrustCapital. That growth? Tax-free. You keep the full $50,000. Same crypto. Completely different outcome. iTrustCapital lets you hold crypto in a self-directed IRA, trade 24/7, and secure your assets with institutional-grade custody. You can also hold gold, silver, and stake certain assets. Real U.S. customer support. $100 bonus when you fund through the link below. In crypto, structure beats timing. Every time. Raoul Pal's core argument is surprisingly simple. While most investors remain focused on short-term price swings, he believes the real opportunity lies in understanding the long-term adoption trend. If crypto continues following the same network adoption patterns that have defined other transformative technologies throughout history, the industry's growth over the next decade could be far larger than most people currently imagine. In his view, the biggest risk isn't necessarily sitting through volatility, it's failing to participate in the long-term compounding process altogether. To help investors think more systematically about these opportunities, Pal introduces a framework designed to remove emotion from decision-making. Rather than constantly guessing tops and bottoms, the focus shifts toward accumulating during periods of weakness and creating a repeatable strategy that can survive multiple market cycles. But perhaps the most important insight comes next, as Pal explains why so many investors struggle to execute even when they know what they should be doing.
For me, I've spent so much time thinking about this and seeing the obsession over X and on the Real Vision platform with the cycle, the cycle, the cycle. I must take the money off the cycle. I must buy the bottom. And I've seen it time and time again, is even if you time taking money off, right, the probability of you putting that all back in later is pretty close to zero. In fact, you end up not sure where the bottom is, so you'll end up scaling on the way up, and you end up doing what I did, which was it up over time by being suboptimal in that process. You're really better to try, if your game is to make some long-term wealth, compound, and then by buying when it's oversold, and then you will have a lot more wealth in the end, and you can make bigger decisions with that, as opposed to the fear in the cycle. But everybody is different, so I want to make that easy for you. So your core thing for me is, how do I solve to have cash when the market's down? That's not always easy. You know, if the business cycle's lower, your business is not doing as well, your earnings are probably not good, you're probably feeling a bit tight, you probably have some inflation eating your savings, but somehow you need to solve for the cash to deploy when the market's oversold. Some of it can be from selling when it's overbought. Others, you just need to save money and keep adding. Make it easy, part two. So the other part of this is saving yourself from yourself. And how I think about it is, there's some pretty easy bets to have. You can just own Bitcoin. It'll work. It's not going to zero. Adoption over time goes up. ETH. ETH is the most lindy out of the smart contract platforms. I've grouped the smart contract platforms that I think matter here because I've done a lot of work on these. And ETH has the most economic and intellectual density and the most lindy effects. There's more developers, there's more protocols, there's more layers, there's more use cases, there's more users, there's more DeFi, everything on ETH. This is why the financial system is likely to adopt EVM, ETH, and layer ones as its core, because it has all the proven elements that are necessary. It's super secure, it's never gone down, and all of the things that we know. Great. ETH is great. Solana, a newer upcoming token, obviously came last cycle. It outperforms because it's newer, but it's also solving for one of the key components, which is it's faster and cheaper. So it's fast, cheap, and secure. And so that opens up many new cases that didn't exist on ETH and even don't exist on ETH layer twos. ETH layer twos tend to not accrue as much value as layer ones. Layer ones are the protocol layer. This is the infrastructure layer for the internet. This is the infrastructure layer of where AI meets the internet. It's the global coordination layer. This is why layer ones are so important, because they are the infrastructure of the future and everything gets built upon them. If you think of a layer two being built on ETH, just building and compounding the value of ETH itself. In fact, when you want to value a blockchain itself, one of the lenses I'm using now is like, well, what you want to do is, let's say ETH. Let's say we turned off the switch to ETH. How much economic value gets destroyed? Well, that's every layer two, 70% of the entire stablecoins market, all of DeFi, all of NFTs, and then it's the future ability, all the real world assets, and then it's the future ability for the finance system and others to build upon those rails. That's a lot more than the ETH value today. ETH is an incredibly important ecosystem. Solana becoming increasingly important. Use cases because of the speed and the cost is amazing. And Sui's the other one. The caveat, you know, I'm on the Sui Foundation, so you'll assume I have a bias, but I've actually done a lot of work on this. And I think that the only layer ones that really matter at this stage, and provably so, are these three, with Sui being the earlier, more speculative, more volatile component part. So why these four? Well, Bitcoin we kind of know about. It's very straightforward. It's not programmable. It does its thing. It's the global store of value. The only competition it has is probably from Zcash, which is the private version of Bitcoin. That's it. There's two competitors, and over time, Zcash will get a percentage share, call it 10%, whatever it is, of Bitcoin's total value, but Bitcoin keeps going as a larger share of global savings because that's its denominator. That's what it goes against, is a share of global savings, much like gold has done. But the networks, this is where these are technologies, and people think of them as currencies, all of that bullshit. The token is just your stake in a technology network of the internet of the future. It's the coordination of value. It's the coordination of agents. It's the coordination of identity. It's the global coordination layer for the digital age. You want to own that. In fact, being given the ability to own it is one of the greatest things that we've ever been gifted, because ETH in Nigeria is the same and as easily accessible by anybody with a phone as it is in the Philippines, as it is in London, as it is in the US, as it is in South America. It's a global, fungible, homogeneous product that is fractionizable so everybody can put in 10% of their savings. This is our way of participating as the machines start using these layers and the whole world goes more digital, our way of participating in the future machine economy, so we don't get left behind.
What makes Raoul Pal's perspective particularly interesting is that it comes from experience. He openly acknowledges the mistakes he made trying to optimize every market move. The lesson he arrived at after years of investing is that chasing perfect entries and exits often creates worse outcomes than simply participating in powerful long-term trends. Investors become trapped in uncertainty, waiting for lower prices that never arrive, or hesitating to re-enter after selling too early. His broader thesis extends beyond Bitcoin alone. Pal argues that investors should view many leading crypto assets not merely as currencies, but as ownership stakes in the infrastructure of the future digital economy. Whether it is Bitcoin serving as a global store of value, Ethereum powering a growing financial ecosystem, or newer blockchain networks enabling faster and more efficient applications, he believes these technologies represent foundational layers of a rapidly expanding digital world. Perhaps the most compelling part of his argument is accessibility. Unlike many technological revolutions throughout history, participation is not limited to large institutions or wealthy investors. Someone in Nigeria, the Philippines, South America, Europe, or the United States can access these networks with nothing more than a smartphone and an internet connection. For Pal, that makes crypto one of the most democratized investment opportunities ever created. Of course, no investment strategy guarantees success, and every investor must consider their own risk tolerance and financial circumstances. But the central message remains clear. If crypto adoption continues expanding and the digital economy keeps growing, patience, discipline, and consistent accumulation may ultimately prove far more valuable than constantly trying to outsmart every market cycle. If you found this discussion valuable, please help us continue growing the channel. Like this video, subscribe, share it with friends and fellow investors. Also, be sure to check out our other videos covering Bitcoin, crypto markets, macro trends, and expert interviews. Thank you for watching, and we'll see you in the next video.